Welcome to the latest Eversheds Sutherland Legal Insights podcast.
Hello, and welcome to Hot Takes, the companion podcast to our series of interviews with leaders and luminaries from the financial services industry, exploring trends and opportunities in global financial markets in 2025. I am joined today by my Eversheds Sutherland colleagues, Bob Copps, co-head of our global corporate practice and U.S. head of M&A, and Paul Pugh, leader of our financial services M&A team. I'm your host, Sierra Nicholson, global strategy and development lead for the financial services sector. Bob, Paul, welcome.
Thank you.
Great to be here. Delighted to be here.
Great. I'm so glad to have you both. We've just listened to our colleague Matthew Allen's conversation with Nikki Eastham, who's the head of M&A at Specialist Risk Group, and they covered a lot of M&A ground in that conversation. So I'm excited to hear your hot takes on their discussion. One point of discussion was the concept of scale and how it can mean different things based on the type of company, the market the companies are, or the markets that the company's operating in, the focus of their strategy. I thought it was really interesting that Nikki defined scale as the point at which you begin to experience a disproportionate competitive advantage. Bob, I know you've recently hosted the Eversheds Sutherland Global M&A Conference, which was in New York this year. I'm just curious to hear if Nikki's comments on scale resonate with what you're hearing from others in the M&A space.
Yeah, it was interesting. And I'm glad you just reiterated the point of how Nikki defined scale, because sometimes when I think of scale, I think of just size. But she did not define it that way. As you noted, she defined it as the point where you begin to experience a competitive advantage. And that certainly came up at our M&A conference. We had a great group of speakers and panelists and talked about all sorts of things. But the idea of scale, maybe not that particular word in terms of its usage, but more in terms of why do companies do M&A? What are they trying to achieve and how are they achieving it? And in terms of why companies do M&A, it was certainly a theme, that folks are looking for a strategic advantage in some way, shape, or form. Sometimes that can be size. Sometimes there are just economies of scale in an industry that a company has decided it needs to seek and try to obtain to become more profitable, more dominant in that space. But there are other things that give companies a competitive advantage, and I think we're seeing quite a bit of that this year. There's technology, for example. We're seeing M&A deals done for the primary purpose of acquiring specific technologies. Maybe in an industrial company acquiring a tech company that otherwise has nothing to do with its industry, but the industrial company wants to be able to take advantage of that technology. Similarly, the race for talent, and I think we've seen that in AI transactions this year, even different structures of transactions, acqui-hires and reverse acqui-hires. The idea is that some companies just want a deeper and stronger bench to position themselves to develop things going forward. They're not even acquiring a technology. They're just acquiring the talent that they need on a going forward basis. And there's an arms race in certain industries, again, particularly AI, for that type of talent. So in that context, scale means the personnel you have within your company. So yes, in different shapes and forms, that was a theme throughout the conference.
That's really interesting, Bob, and it's reminding me of the phrase that I've heard used a lot when we talk about just kind of the evolution of technology within the financial services industry. And the question is always, do you buy it, do you build it, or do you borrow it, right? Do you partner with somebody who can borrow it? And it sounds like from what you're saying that a lot of companies, just not just with tech, but a lot of companies are really using that buy strategy to get what they want, whether it's the existing technology or the talent to make the technology. Paul, I'm going to bring the same question to you. Just what were your reflections on Nikki's comments about scale and how she defined it?
Yeah, sure. First, I'd like to personally thank Nikki for her insights. Specialist Risk Group is a great success story, and it's been a privilege to be a part of their growth both in the UK and now internationally. Great vision and great management team. I think some of my observations on the financial services market, I suppose I could like to kind of out of that probably two things. The kind of at the moment the what and the where. So, and these very much go to what we mean by scale, as Bob was saying. The what, I think in the financial services, it's sometimes very hard to stand out as a company. You need to be laser focused as to what you are selling. And I think companies like Specialist Risk Group have clearly done that. You don't need to be a specialist insurer. You may be, putting yourself out as the best platform for asset managers. You may be the most user-friendly payment system. You may be the most ethical bank. You need to be at scale in that area which you are the best at. And I think the other thing we need to consider is really kind of the where. That's also important. Where are you trying to sell? Where are you trying to do deals? If we look at kind of recent pitch book data, clearly the bulk of financial services M&A deals are in the US, around about 40% in 2025 have been in the States. Europe is also very, very hot at the moment. So about 25% of deals in Europe, 15% in Asia. Middle East, which you would expect to be higher, is about 2.5%. So perhaps that's an area which we should be looking, companies may be looking to scale up and to grow in.
Great, thanks, Paul. And I really like that between the two of you, I feel like we've covered the why, the what, and the where, which are all really important concepts. And I imagine must be very grounding from a strategic standpoint when you're looking at your options on the table. You can keep coming back to like what's your why, right? And what's the what that you're good at? And are you making, investments and choices aligned to that? Paul, I'm going to stick with you for a minute because another thing that Matthew and Nikki talked about was the role of PE in shaping M&A activity. And specifically, Nikki talks a bit about the demand for both platform acquisitions and bolt-ons. And I'm just curious to hear from you what growth strategies you're seeing play out in the market in terms of leveraging PE interest.
Yeah, certainly. I mean, there's a lot of chat in the market, and there has been for a couple of years at least now about the kind of the mythical dry powder that is floating around amongst the funds. And I think it probably isn't a myth. I think we're starting to see it being deployed quite significantly at the moment, whether it's $2.5 trillion or not or more. I don't think anyone's particularly certain on, but it's certainly there. I think there are three areas where I'm seeing significant activity at the moment. Certainly, consolidation is still very, 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 very active, and that cuts across all of financial services and quite frankly covers all sorts of different jurisdictions. I think there was some hot area. UK was certainly a hot area and remains to be a hot area, but mainland Europe is growing, and there are some very exciting transactions which are PE backed. Financial innovation is an area which is coming to the fore. So kind of areas such as agentic AI, stablecoin, those type of areas are gaining a lot of investment interest. And more broadly, and again, as Bob has mentioned, more widely technology, which includes AI, is still very attractive and very much of the moment. I think what is coming out loud and clear now, though, is there has to be a strong business case behind the technology. I think there is concern that investments will not be made just because it's got an AI badge on it anymore. You must understand why the technology is being used and what benefit it is bringing to a business's customers.
Great. Bob, just coming back to you, something that Nikki talks a lot about was thoughtfully undertaking M&A and not assuming that every deal is going to be a good deal or the right deal. What factors should be taken into consideration when assessing whether a deal is the right deal or not?
Her point is a good one. There's an old adage that sometimes the best deals are the ones you don't do for whatever whatever the reason may be. I mean, I think it depends on the acquirer and what they are looking for. Obviously, a financial, there needs to be a strategic rationale for the deal. The deal needs to make financial sense. I think Nikki referred several times to the importance of cultural fit, which, the three of us are in a law firm. We know how important that is here in a people business. I've seen that and its importance across many other industries as well. And there needs to be, I've seen a few deals this year, as with years past, just die during the early stages because of risks that were unearthed. And those altered the risk reward framework for the transactions. And again, the acquirer said, you know what, I don't really want to move forward with that. Or on the other hand, the sellers weren't happy with the shifting of the risk back to them. So that's certainly a factor as you get more into a specific M&A process. And then increasingly, and we talked about this a lot at our M&A conference, as we have at our last 3 M&A conferences before that, there needs to be an antitrust and foreign direct investment assessment done early on to make sure that you think you can get your deal done. A decade ago, and we've talked about this, Paul and I and others on our global M&A team, it was almost like the antitrust or FDI filings were kind of a check the box at the end of the deal. Once you had all your deal terms negotiated, you knew you were going to sail through. So you made your filings and you went on to closing. Now, in this geopolitical environment, particularly in certain industries, defense, technology, critical infrastructure, I'll say technology again, just because we see it all the time on both the antitrust and the foreign direct investment front. A strategic assessment really needs to be done up front, to make sure that both parties think the deal can get through.
Just to add to that, Bob, I would completely agree. You always have to due diligence the transaction process in addition to due diligencing the target itself.
Well said. Yep.
Yeah, and can I ask an off-script question? Just because the technology theme comes up so much, and Paul, you were mentioning the financial innovation point, particularly in your last comments, and I know that you work with a lot of fintechs and other tech companies. When companies are assessing a deal and are making an investment that's going to bring them a technology, and thinking about the risk reward model that Bob mentioned and how that can shift, do you find that are a lot of companies able to keep pace with like assessing the risk that things like agentic AI could create, or are there challenges there?
It's enormously difficult because you need to look at the two things. I think Bob alluded to this when he was mentioning things like acquihires and reverse acquihires. Do you go for the technology or do you go for the people? And which is the most important? And my experience is often the people are more important than the technology, and it boils, technology is kind of progressing at an incredible rate at the moment, and we shouldn't underestimate the fundamental changes that this generation of AI will make. However, we will always need good people in order to kind of use the AI to make it work, to make it run. So that is, I think, with any business acquisition, that's always at the heart of the deal.
Great, thank you. Thanks for indulging me an extra question. One last one for you both before you go. I'm just want to know what's one trend that you'll be watching in the M&A space in the year ahead. And Bob, I'll start with you.
I apologize for continuing to refer to our M&A conference, but it really was very interesting. And one of the themes that emerged And we were kind of seeing this, but it's always good to have experts validate your hunch or your views. One theme that several of the panelists noted was a separation in terms of deal activity between high quality assets, mid quality assets, and low quality assets. And by assets, I mean target companies. And the reason we were talking about that was because so far this year, the aggregate value of deals done has been on an upward trend, but the volume of deals has been trailing. So you're seeing a lot of high value deals get done as opposed to just a large number of deals. And our panelists were saying that high quality companies seem to be trading hands among strategics or private equities at increasingly more valuable valuations. Whereas assets that aren't as strong or perceived as being as strong are struggling to be sold. So you have owners of those maybe trying to offload them, but they're just not perceived as strong enough. And those sales processes are either not happening or taking a really long time and seeing the deal morph into different iterations. And then there's even a lower category of deals that are just really challenging or have a lot of hair on them. And the panelists seem to think some of those are actually getting done at the right valuation. Once the sellers come to grips with the fact that this asset they want to sell isn't quite as pristine and valuable as they think, and there's a lot of work to be done to clean it up, buyers and sellers can work together to do that, assuming the buyer doesn't have to pay too much money for the asset. So one of the trends I'll be watching is whether that separation continues or whether we'll start to see valuations adjust in that mid-range, leading to greater volumes of deal activity. And as Paul mentioned earlier, it does seem like there's a little bit of an uptick right now. So maybe that's starting to happen. We'll see.
Okay. Paul, what about you?
I'm going to be more specific. Things that are interesting me at the moment. I know you said one, but I'm going to have two. Firstly, crypto assets. I think the regulators are finally getting their act together to put frameworks in place in various kind of jurisdictions around the world, and I think obviously very kind of positive support from the US at the moment. So I think watching keenly to see what happens in that space over the next 12, 24 months. And then the second area, which is one I've kind of alluded to earlier, is what's happening, the growth of the Middle East in financial services, M&A. That market is probably going to, I suspect, run quite hot for once it gets going, and then there's a great enthusiasm to embrace financial services technology in the region. It'll be exciting to see what happens.
Great. Thank you both for your time today. And of course, we're grateful to Matthew and Nikki from Specialist Risk Group for giving us great food for thought and discussion. Tune in all year long for more hot takes.
Thank you for listening to the Eversheds Sutherland Legal Insights podcast.